In 3 simple, fast steps. Step number 1, we need to review the basics from Chris Cole's amazing paper, and we'll put a link to it in the description below. The paper is called The Allegory of the Hawk and the Serpent. Sounds a little complex, a little philosophical, but trust me, it's amazing and pretty darn straightforward. Let's start with the charts. We have a chart of U.S. Treasuries going back to 1929 and U.S. stocks going back to the same date, all the way to today, 2020. On the left-hand side with the Treasuries, we have a dollar amount going from $1 all the way up to 21. On the stock side, going from $0 to $10. This represents the dollar gain that you would have in your portfolio. And Chris breaks things down into these cycles. They happen to be about 20 years. And of course, one cycle is the serpent. The other cycle is the hawk. We'll go into details in just a moment. But in 1929, during this hawk period from 29 to 46, treasuries didn't do much at all. And equities during the same time frame actually went down in value. Then from 47 to 63, we have a serpent period. Treasuries didn't do much, but stocks went up tremendously. Keep in mind these charts are in nominal terms. They're not adjusted for inflation. From 64 to 83, a hawk period again. Treasuries don't do much, if not go down, and stocks just go up a little. Then we get to this massive serpent period from 1984 to 2007. Look at this. Treasuries go all the way up. If you started with $1, you'd end up with almost $22. That's just in treasuries. If you also had stocks in your portfolio, they go from 0 all the way up to 11 or 12. Tremendous gains. In fact, if you take the entire gain from an average portfolio, I'm talking about 60% stocks, 40% bonds, you take that back over the last 90 years, and 91% of the gain came from 1984 to 2007, just that serpent period. 91% of the gain. That means in the other 70 years, there was only a 9% gain in that person's portfolio. Then starting in 2008, we go into the next hawk period. Treasuries haven't done much. Stocks have gone up substantially, but keep in mind, we're only 10 or 12 years into the cycle. We've got another decade to go. To dive into greater detail, let's go straight to Chris Cole's paper, Allegory of the Hawk and the Serpent. The Allegory of the Hawk and the Serpent is a philosophical map to understanding the generational cycle of wealth creation, destruction, and rebirth to help guide your investment decisions and protect your prosperity. The serpent represents a period of secular growth, secular is long term, fueled by the virtuous cycle of value creation and rising asset prices. The growth cycle begins naturally through some combination of favorable demographics, technology, globalization, and economic prosperity. As the secular boom matures, it's corrupted by greed as fiat devaluation and debt expansion replace fundamentals as critical drivers of asset price gains, not unlike a serpent devouring its own tail into oblivion. Greed, fiat devaluation, and expansion of debt replace fundamentals. Wow. How much does that remind you of exactly what's happening today? The hawk signifies the forces of secular change that will challenge and ultimately destroy the corrupted growth cycle of the serpent. The left wing of the hawk is a deflationary path, whereby an aging population leads to low inflation, faltering growth, financial crash, and then debt default. The right wing of the hawk represents inflation, fiat default, and helicopter money. The pattern is as old as money itself. Now that we understand the two cycles a little bit better, the hawk and the serpent, let's go into some details on what happened. How did we have such massive growth in the time frame between 1984 and 2007? It starts with demographics. We had a huge glut of the population. The baby boomers go into some of their peak spending years in the early 1980s. You combine that with a dramatic cycle of falling interest rates the entire time, going from almost 20% all the way down to 0%. This creates an environment of continually rising asset prices. Next, we had globalization, which kept consumer prices low, and an explosion of debt. Not only government debt, but corporate debt and consumer debt. Let's go to the left-hand side of the whiteboard and we can get a visual how this played out. We had the real economy and all these people coming into their peak spending time. They're making money. They want to buy houses, cars, go on vacation. They want to spend money. So the Fed says, we've got your back. We'll lower interest rates and we'll print up funny money. There'll be a Fed put, so don't you worry about it. And the banking system comes in and says, yes, we'll do the exact same thing. We'll get aggressive. We'll shower you with as much debt as you're willing to take on. So home prices go up, the price of vehicles go up, and the 401k goes to infinity and beyond. The bottom line is you had a huge population with unprecedented purchasing power. And remember what Ray Dalio has taught us. One person's spending is another person's income. We had huge increases in spending and incomes, which led to a booming economy and booming asset prices. But unfortunately, as you know, there's no free lunch. It also created an even bigger doom vortex. So what time is it now? I think you know. It's stiff drink time. Step number 2, recency bias and the risk parity portfolio, which is basically a 60-40 stock bond split. The recency bias goes back to every single financial advisor you have ever heard telling you to buy the dip. Well, does it work? Let's go right back to Chris Cole's charts and check it out. 1929 is our start all the way to today and moving forward because we're still in the next cycle. It goes from $0 on the left all the way up to $3. This represents the value of your portfolio. 1929 starts off at $1, goes up, but then it comes crashing down to 1946. So if you would have had the buy the dip approach during this time frame and a 60-40 split between stocks and bonds, you would have gotten crushed. Same thing between 47-63 and 63 to 84. It's only been recently, and just in the United States, I might add, where this buy the dip risk parity portfolio approach has actually worked well. But I'd like to remind everybody that markets, and the world for that matter, operate in cycles. What goes up comes down. What goes down goes back up. Just because something happened in the recent past doesn't mean that it's going to happen indefinitely into the future. I'd also like to point out that if you look at the time frame between the late 1990s and today, it represents almost 100% of the gains in the housing market, going all the way back to 1900 when you adjust for inflation. Also, looking at this chart from Chris Cole, we need to remember this doesn't include what's happened recently with the cerveza sickness. So how is this 60-40 risk parity portfolio buy the dip approach going to work out in the next cycle? Well, to get some insights on that, let's go to a clip from my full-length interview with legendary hedge fund manager Hugh Hendry.
Every expert like me, every pro, looks like a dumbass when you consider the investment strategy of the permanent portfolio. I'm sure at some point it's going to be on your whiteboard and you're going to explain the concept of the permanent portfolio, risk parity. You're the biggest hedge fund in the world. Ray Dalio kind of plays this theme. He does it like with adjusting for risk, but you sit there with 25% of your portfolio in precious metals, gold, and maybe a bit of silver. You sit there with 25% in the S&P, or maybe have a bit of NASDAQ or whatever, You sit there with 25% in government bonds. You might have a little bit at the short end. You might have a little bit at the long end. You might even have a bit of commercial. And then you sit there with kind of cash and looking for opportunities. You sit there. That strategy for the last 40 years has just wiped everyone. It's the leader. It's the Olympic. It's the Usain Bolt or whatever. I don't know the American sporting analogies to make, but it has hit the ball out of the park time after time after time.
Yeah,
it's finished. This is a time to preserve capital.
So as Jim Rogers always likes to say, this risk parity portfolio buy the dip strategy is going to be a fast way right to the poorhouse. And it makes sense when you go back and look at Chris's chart. From 1929 to 46, this approach would have gone bust. 47, 63, bust. 64, 83, bust again. The bottom line is people that advise taking this approach are suffering from the recency bias I always talk about in my videos, and Chris Cole outlines this beautifully in his paper. But let's go back to step number 1 for a moment. How did we have this huge boom between 84 and 07? Demographics, falling rates, rising assets, globalization, and a massive expansion in debt. But in the next cycle, that most likely won't continue. We're going into a period of bad demographics, rising interest rates, falling asset prices, deglobalization, hashtag cerveza sickness, face masks, pharmaceuticals, etc., and a debt contraction. And this takes us straight over to the doom vortex. The largest percentage of the U.S. population, the baby boomers, are going from peak all the way down to weak. And I'm not talking about them just walking around with canes or in wheelchairs or whatever you're doing. And I'm not implying that if you're a baby boomer. I'm just saying they're going from peak spending all the way down to very weak spending. You combine this with the reversal of the cycle we had from 84 to 07, this leads to less spending and less income, which means lower GDP. The worse the economy gets, it goes right back to the baby boomer generation. They have a lower propensity to spend and consume. This takes us straight into a depression, which Jeff Snyder calls GFC 2.0. The big question is whether the depression is going to be deflationary or inflationary. Whoa, time out. I wanted to throw in another bonus from Chris Cole's paper just to give you some food for thought. It's a quote from Bill Gross, the bond king himself. Let me admit something, Bill Gross says. There isn't a bond king or a stock king, or an investor sovereign alive that can claim title to a throne. All of us, even the old guys like Buffett, Soros, Foose, and even me, have cut our teeth during perhaps the most advantageous period of time an investor could experience. An investor that took marginal risk, levered it wisely, and was conveniently sheltered from periodic bouts of deleveraging or asset withdrawals could, and in some cases, was rewarded with the crown of greatness. Perhaps, however, it was the epic that made the man as opposed to the man that made the epic. In other words, were the greats that 99% of the investing public tried to emulate actually great? Or were they just at the right place at the right time? I'll let you be the judge. Step number 3! Now let's take a look at Chris Cole's Dragon portfolio. We go down to the pie charts. The typical portfolio structure that all the normies out there have, just like your friend and family member Fred, comprises of 73% stocks, 21% bonds, and 7% cash. The exact portfolio Hugh Hendry was just referring to. But the Dragon portfolio is much, much different. And just a warning, if you like this type of portfolio, I can guarantee you they're going to call you a tinfoil hatter for sure. Because it only has 24% stocks, 18% bonds, 19% physical gold, 18% commodity trend, and this is a type of trading or a type of investing where you follow trends in commodities. Also, 21% long volatility. When we look at the charts, how did these two strategies perform over time? Start at 1928, go all the way to 2018. With the Dragon portfolio, if you started with $1 in 1928, by the time you got to 2018, you would have over $100,000. What's even more incredible is if you look at the time frames we discussed in steps 1 and 2, the Dragon portfolio does extremely well regardless of whether or not we're in a serpent cycle or a hawk cycle. And to take it a step further, the hawk cycle can be inflationary or deflationary, the complete opposite of one another, and the Dragon portfolio still crushes it. And what would happen if you would have taken the advice of every single financial guru on YouTube and just bought the dip? Whenever stocks go down, you're buying because you know the stock market always goes up over time. You would have started with $1. At the end of 2018, you'd have right around 4 cents. And that doesn't even include inflation. So excluding inflation, you still would have lost about 96%. So your friend and family member Fred, who's telling you you're wearing a tinfoil hat because you don't want to buy the dip, gets absolutely crushed. While you, the tinfoil hatter who dares to go against the grain and challenge the mainstream narrative, does extremely well and gets rich. So now what you're saying to yourself, I'm sure, is, yes, George, I'm a tinfoil hatter. I agree. I'll raise my hand. I admit I'm coming out of the closet, a tinfoil hatter. But how do I set up this Dragon portfolio? Or maybe even better yet, how do I set up a hawk portfolio? Because I think the cycle of the serpent has come to an end. Well, to find out, you're going to have to tune in to Monday's video when I'll discuss both of these topics. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.